From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, February 10th. Here are the top market stories we are following for you this hour. Well, hot American wallets getting hit again with a higher than expected jump in consumer prices. Inflation charging ahead at the fastest pace since 1982. And now the spotlight is on the Fed. Money markets are betting a whole percentage point of rate hikes by July. Do traders have it right? Will March be the start of a historic tightening cycle? And is 50 basis points back on the table? And turbocharged, Aston Martin unveiling its latest Formula One car. We'll have an exclusive interview with none other than Aston Martin F1 team owner Lawrence Stroll on what they're doing to keep the momentum going. From New York, I'm Kriti Gupta with Guy Johnson, and Alix Steel is off. Welcome to Bloomberg Markets.
That was a hot number, wasn't it? Certainly caught a few people on the hop. Big reaction, Kriti, certainly at the front end of the curve a lot flatter. We're seeing an impact over here in Europe. The real question is, does this change the narrative for the Fed? A lot of people, Scott Minard included, talking about the fact that 50 is now on the table. I think we're pricing 50-50 on 50 for March. So let's talk about our question of the day. Is the number we've just seen peak inflation? Does it fade from here? Or is there more momentum behind the inflation narrative than we first thought? Let's bring in Bloomberg's international economics and policy correspondent Mike McKee over in New York and Bloomberg Markets editor for rates, Christina Kino, joining me over here in London. Mike, let me start with you first of all. Is this peak inflation? Is there anything within these numbers, within this data, that we can use usefully to determine whether or not we go higher from here or fall from here?
Well, unfortunately, because there's so many categories, there isn't really a way to tell. We do have some clues, however, and there was a little bit of good news in there. We did see used car and new car prices start to moderate their increases. Used cars was the lowest increase that they've had since last September, and new car prices actually dropped a bit. So they've been a big contributor. They're about 10% of the CPI, and if that continues, that'll put some downward pressure on it. We'll see what happens with energy prices going forward. We'd had flat gas and gasoline prices during the month, so those categories went down. Energy overall was up, but it was just energy services. Rent is going to stay in there. So you're going to have to put up with the fact that home prices are going to go up. However, the Fed raising interest rates will have an impact on that sooner or later, because it'll be one of the most sensitive sectors to what the Fed does. So there are some reasons to think we might be close to peak, but it's hard to say whether it's this month or next month.
Christine, hop on in here, because the immediate reaction off of this very hot inflation report was 10-year yields getting higher and higher, nearing that 2% level. I think some contracts even trading just above. Talk to us about what that means. What is the bond market pricing in when it comes to peak inflation or perhaps persistent inflation?
Well, Kriti, I think the reaction is very much reflective of the fact that the bond markets are getting another dose of reality that inflation is here to stay. And I think, that reaction in the 10-year yield, potentially just a sign of more yield moves to come and more thresholds getting broken here as this flows through markets. I think it's very important as well that in terms of the shortened pricing, we are seeing that 50 basis point rate hike possibility really getting nailed on for traders. But more especially the July pricing of 100 basis points. That to me is actually more significant, because that implies that there will be at least a 25 basis point rate hike for each of the 4 Fed meetings between now and July. That's pretty significant.
Can I just clarify something here? And Kriti raises it, and it's been hopefully clarified for me by Bloomberg's Cameron Cries, because I've been asking the question, do we get north of 2% or do we not get north of 2%? His answer to this, the old, in inverted commas, 10-year bond, which basically had a maturity 31st of the 11th, i.e. November, traded at just over 2%. The new one, again, inverted commas, auctioned yesterday, Kriti, peaking at 1.9997. You need to go to 4 decimal places, as John Ferro continues to point out. But it just depends, as you say, on which one you're looking at, depending on whether or not we got north of 2%. But we haven't sent it hot yet, so we'll watch for maybe that new one to go through 2%. Christine, let me carry on with you this conversation about what the Fed does with this number. It's going to get another figure between now and the next meeting. And this comes back to our question of, does it come down from here? Is this peak inflation? Does it start to subside from here? It would have to, I'm assuming, subside significantly for the Fed to alter course, for market pricing to change significantly around this as well.
Absolutely, Guy. I think there's probably little question that the Fed will have to act one way or another in March because market pricing has kind of pushed them toward there. And they've indicated themselves that they really are prioritizing the reaction to inflation. And so whether it's 25 or 50, that's another conversation altogether. But in terms of indicating, signaling that they will be doing something come March, that's almost a sure thing at this point. And, in terms of the question of whether this is peak inflation or not, I'm afraid it's not, because I'm just listening to what we've been hearing from various companies during this earnings season. And a lot of them are declaring that they have pricing power. And so that really means that there is a potential for the second round effect of even higher prices for goods and services in the coming months, because these companies are feeling empowered to raise their prices. And so even now that the hard data is showing this is where inflation is, it's already quite hot. I'm afraid that there's potential for it to get even hotter in the next few months here.
So, Mike, we'll bring you back into this conversation here. If this is peak inflation, does that mean that the Fed's original stance, the idea that inflation was actually transitory, does that kind of come back into play, or are we still concerned about simply inflation sticking around and therefore kind of justifying a more aggressive rate policy?
Well, it does justify a little bit more aggressive rate policy, and it's not just a question of whether it was transitory or not. I mean, it's been around long enough now that it's actually affecting people's lives, so the Fed is going to do what it can. There are questions about what it can do. It is, to the extent, a supply side problem. The Fed is going to have less of an impact on that. And they want to be careful because we have gotten a lot of people back to work, and they don't want to slow the economy so much that starts sending people away. In some ways, at this point, we're all just sort of dancing on the head of a pin because inflation goes up, the Fed raises interest rates. That's, dog bites man. And whether they do it 4 meetings in a row or whether they spread it out doesn't really matter much to the overall economy, given that it works with a lag. It's more a question of how you're going to trade it than anything else.
Mike, is there a danger, though, that the Fed has to play catch up? The Fed has already moved quite a long way relatively quickly. But is there a danger, and I'm wondering kind of what Fed speak is going to look like over the next few days, that the market needs to be lined up for even more aggressive policy? And if so, how do you see that happening? How does the communication work in the build-up over the next month or so?
The communication we've gotten in the last couple of weeks is we don't think we need to do 50 basis points at any particular meeting. That could start to change. They could start to signal that they're more open to the idea if they need to do it. They probably won't say much about doing something at every meeting because they'll want to leave their options open to see what happens with that next CPI report. And they do like the idea of pausing to be able to see what happens with the economy when they raise rates. But if the market is moving up the way it is, it's going to have an effect. We could see, certainly, we're seeing some inversion at the very high end of the curve. We could see some inversions in 210s. And if that happens, that's a signal the market thinks the Fed is going to go too far. So it might push them the other way. You can see the inflation break-evens that I was talking about earlier this morning on surveillance. I said, watch these, and if they go way up, then the Fed is going to be pushed to do more sooner because they're worried about the inflation expectations becoming unmoored. And you can see what happened today. Let's see what happens over the next day or so with those. But obviously, the Fed would see a problem there that they might want to address.
Christine, let's bring you back into this conversation and take it global, because overnight we also got some news that the BOJ, the Bank of Japan, is also sticking to kind of their dovish stance. We know that the ECB has kind of sort of made a hawkish pivot. What does inflation in America signal perhaps about what the inflationary trends are in the rest of the world?
Well, Kriti, central bankers would want to argue, oh, we have a different regime, we have a different economy from the rest of the world, and therefore we're going to be doing monetary policy our way. That's certainly something that we heard from the Riksbank, for instance. It's the Swedish central bank earlier today arguing that it's not just going to follow in the footsteps of the ECB, for instance, which is arguably a bigger economy or a central bank presiding over a bigger economy. It's going to go its own way because it has a different inflation profile. And I think it's going to be interesting to watch actually how these central bankers kind of diverge from each other or converge heading into the next couple of months. Markets are mostly uniformly moving toward the expectation that policymakers are going to have to pivot more hawkishly, but perhaps we might see a little bit of a pushback from certain central bankers in different parts of the world, and therefore creating some interesting divergences to trade off.
Well, Bloomberg's Michael McKee and Christine Aquino, thank you so much for your time. We really appreciate it with your insights as always. Coming up, we'll get another take on whether we've seen the worst of inflation. We dive into those CPI numbers with Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. This is Bloomberg. Let's get back to our question of the day. Is this peak inflation? Joining us now is Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and CIO. Mike, thank you so much for joining us. Well, let's just start there. If this is peak inflation, which I think was the consensus going into this kind of CPI report, what does that mean for the consumer? How are you thinking about this?
Yeah, I think we agree with the premise that the rate of change on inflation is probably peaking, and a lot of these metrics in this high frequency data is also very volatile, right? So the idea that, we're going to trade this data is that precise, I think is a bit of a fallacy, but directionally it's a little bit hotter. So all that really means is that the Fed is not going to be going more dovish. And I think the equity markets in the last few days have been kind of hoping that the Fed, maybe isn't going to go as quick as they were fearing a few weeks ago. And this pretty much throws cold water on that. But that's been our view all along. With whether inflation's 7.3 or 7.5%, they're going to go hard until they either get inflation down to a more palatable level, which is a long way from where we are, or we get markets to really break down, then they got to back off. And we're just so far from that right now that it doesn't change our view in the Fed whatsoever.
Mike, if these kinds of numbers though do persist, and I hear what you're saying about maybe starting to slow down, but the rate of change in the slowdown is going to be important as well. This may be the peak, but let's say the slowdown is shallower than we're anticipating at the moment. Would that change your view of how we set this market up? Because at that point, you'd have to be thinking that the Fed not only needs to be more aggressive, but needs to be more aggressive for longer and maybe generates a higher terminal rate as a result of that.
Yeah, this is the $64 trillion question. How much tightening can the Fed actually do if growth is slowing? And I think so our view, we were very focused on the Fed last fall. We felt like, that was the fire part of our narrative. And now here we are. It's very consensus. The Fed is behind the curve and by the way, the Fed's catching up in a hurry. So I think that from a good news standpoint, I would say the market now is probably pricing the Fed correctly. And I would be surprised, quite frankly, if we're able to get through all the tightening that is now being promised by not just the Fed, but the ECB and the BOJ and the BOE, all the developed, major banks. If we do all of that tightening, we're going to have a very significant slowdown, both in the economy and I think markets aren't going to take it very well. So I think the thing we're focused on now, Guy, is how much is the economy slowing, particularly in the U.S. Is the U.S. consumer going to back off here a little bit because real disposable personal income growth is going to be negative in the first half of this year for a large majority of consumers. At the same time, supply is picking up. And I actually think that we could be surprised over the next 6 months how fast inflation comes down as pricing power fades when supply picks up and demand comes down. Now, is that a good thing for stocks? It could be for some because rates come down and maybe that, or at least the expectations on the terminal rate maybe doesn't have to go up anymore. But I think the earnings disappointment, if it's bad, will rule the day, and that's why we continue to be a bit skeptical on S&P 500 at 4,500. We don't think that's great risk reward here.
Mike, let's stick with that theme of slowdowns and that supply buildup. I really want to talk about inventories here when it comes to a lot of these earnings stories. How do you interpret that going into the year ahead? Let's say we have the next, hypothetically, 6 months really focused in on the Fed and kind of the monetary policy there. After that, how much does inventories play into simply the valuations and the way that the stock market trades?
Well, it depends on the sector. Obviously, maybe some sectors don't have any inventory. It's just the way they run their business, whether it be services or some of these asset-light type businesses. And so for those industries, it's not really going to be that big of a deal. And think about it this way. So look, building inventories is bullish for the economy, but it's not necessarily great for earnings. It's the mirror image of what we experienced coming out of the pandemic when inventories couldn't keep up with the excessive demand. But now, of course, inventories are going to catch up, and as demand is fading, not a recession by any stretch, but it will create, oversupply in certain industries. I think consumer goods, some of the, maybe the industrial supply chain, some of the housing supply chain, that's where you're going to see perhaps margin pressure. So even though you have a decent economic situation because inventories are, it's GDP growth, it doesn't translate into earnings growth. In fact, it could translate into earnings revisions to the downside as operating leverage turns negative for a good chunk of the market. That's what we're focused on. We don't know the answer to this yet, but that is the risk that people are not focused on, just like they're overly focused now on the Fed and inflation. That was the story 6 months ago, okay? I mean, that's what you should have been paying attention to then. A lot of that has now been priced in the bond market for sure, and even within the equity market, given the de-rating that's happened for the high multiple stocks.
The other end of the high multiple stocks is the energy sector. If you've been outperforming this year, Mike, you've got to have been in the energy sector. The president called Saudi Arabia yesterday. The conversation, I'm sure, at some point turned to the possibility of more oil coming onto the market. What is your outlook from looking at this market through the lens of the oil markets and thinking about how the energy story is going to be driven from here? Do energy stocks keep outperforming even if energy prices come a little bit lower? This is a core area of the market right now in terms of our performance. Does it stay that way?
Well, it feels that way for sure. I mean, this is clearly an area we've underinvested in. I think it's very, it's becoming more clear that while ESG and, particularly E part, moving to alternative fuels is a desired goal, it's going to take a long time. And we probably didn't invest enough in fossil fuels to make that transition smooth. So that's the bullish intermediate term view, which we kind of share. I think that's a very bullish view for crude to go higher over the next several years. I think that's good for energy stocks. I think the short term risk for energy stocks is that once again, this slowdown that we're seeing right now perhaps even backs up into the energy market as demand pulls back a bit and we have a little bit of a hiccup. I mean, it'll be short lived, I think, be a buying opportunity as far as I can tell. And then, of course, the big, sort of elephant in the room is, what's going on overseas in Russia and Ukraine. I mean, there's definitely some geopolitical risk premium in the price of crude. The question is how much. Nobody knows, but it's probably $5-10.
Mike, let's stick with the theme of energy, of course. So for oil stocks, it's a great thing to see. But what about the rest of the market? At what point do these surging energy prices become more of a headwind for the consumer or a headwind for corporate America and eat into their bottom line?
Well, I mean, look, energy is one component of inflation for sure. So the way I would think about it is if you look at consumer confidence numbers and you look at the surveys of small businesses in particular, these two entities, have to eat the pricing. The confidence numbers are through the floor, mainly because prices are too high. We've never seen readings this high in terms of pessimism around inflation from the consumer or these small businesses. The energy is part of that. It's not the only thing. Is there a magic number on crude that says, okay, we're gonna, things are gonna flip over now or get real demand destruction? There's all kinds of estimates out there. My simple rule of thumb in the U.S. is that once gasoline prices hit about $4 at the pump, on average, we're not there yet, that's when you start to see demand destruction for gasoline, which of course is one of the biggest components of demand for crude oil.
Mike, just wrapping things up a little bit, and coming at this from the earnings point of view, earnings have been super strong over the last 18 months. How symmetrical do you think it's going to be going forward? Almost a bit like the sort of the Fed target. Have we had pull forward? Is that what the last 18 months were about? And if so, from an earnings point of view, thinking going forward, do we get the opposite and equal reaction?
Yeah, it's interesting. I mean, in April of 2020, we were kind of the earnings bull on this positive operating leverage story. And I would say people were slow on the draw on that. It took a long time. And quite frankly, we underestimated how much operating leverage there was. It's just been a phenomenal run. So I think it would be naive to suggest that if we have the normal kind of, boil, roll coming off the boil, if you will, slowdown that you typically at this time of the expansion, that there should be some negative impact on the other side. The payback in demand is one argument. The consumer income growth is another argument. And then the inventory build, which could put pressure on pricing, which is really where all the over-earning came from. It was pricing. There was no discounting because of this shortage. So all three of those are going to play into what I think is not a complete mirror image, Guy, but definitely some payback. And I'll just leave you with one last thought as we think about where's that payback the greatest? Just remember, there's a little bit of Peloton in everyone. Okay, everybody benefited a bit from the pandemic. There's a little bit of over-earning from everyone. And so we're seeing a little bit of that in the earnings season now with other companies kind of admitting to this. And my guess is, that hasn't finished playing out.
A little bit of Peloton in all of us. Mike, on that note, we will leave it. Thank you very much indeed. Great stuff as ever. Mike Wilson of Morgan Stanley, thank you very much. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Twitter sales rose 22% in the fourth quarter. Their social network's ad business held up despite changes to Apple's data collection rules that have hurt some of Twitter's larger rivals. Still, first quarter revenue may fall short of expectations. And it's a sign that Coca-Cola is benefiting from a return to normalcy despite the lingering pandemic. The beverage giant posted fourth quarter sales that beat estimates. Coke says it expects inflated commodity costs to continue this year. And Elon Musk's SpaceX has lost dozens of satellites to a geomagnetic storm. As many as 40 of the 49 Starlink satellites launched on February the 3rd were hit by a storm the next day. SpaceX says the satellites either re-entered the Earth's atmosphere or are on track to do so, burning up in the process. And that is your latest business flash. Guy?
Ritika, thank you very much indeed. Kriti, this is going to be good news for NASA. I think NASA's a little bit worried that Elon Musk is putting maybe too many satellites in space. Apparently, we're not going to be able to see rogue asteroids coming towards us as a result of this crowded low orbit space that we're now creating.
It's kind of wild to me that we're in an era where we have this much space debris in our orbit. Because I just remember not too long ago, I think we just had the International Space Station. That was kind of the only thing up there, right, Guy?
Yep. And you could see it. We used to use it for my children to say that it was Christmas. That was Santa up there. You could see the IS flying across the sky. Anyway, we're going to talk more about the Fed next. This is Bloomberg.
Well, it's about an hour into U.S. trading session. Bloomberg's Abigail Doolittle is looking at the moves. Some red on the screen, Abby.
Some red on the screen, but we're also looking at a little bit of a U-turn here. So the intraday volatility that we've gotten so used to this year, we have it once again. And of course, today's big impetus, that hot CPI print, 7.5%, a 4-decade high. You can see the NASDAQ 100 futures overnight basically flat, and then this massive dip on that hot number. Of course, tech stocks, growth stocks, more pressured by high inflation, rising rates, because it calls into question valuation. But investors rethinking it, calmer heads prevailing, down just about 0.6% at this point. But the day is young. Let's see how it goes. And here are those yields. The 2-year yield, just extraordinary. Now at almost 1.5%. Remember, the 10-year yield started the year at 1.5%. That's almost where the 2-year yield is today, backing up 10 basis points. The 5-year, also up 7 basis points. And then you can see the 10 and the 30 up about 4 basis points. So, of course, the yield curve today is flattening. We continue to watch that flattening. As for where yields may go next, Guy, we have been talking all year and even last year about how it looked likely that the 10-year yield would go above 2%. This is why you have a beautiful uptrend in the 10-year yield out of the pandemic lows. You also have this huge area of congestion as investors were trying to make up their minds what was next. We have a breakout. This entire area of congestion probably suggests we'll have a move in an equal proportion to the upside. That could mean 2.25 that we've talked about. It could mean 2.5. It could even mean 3%. So it could be what will count the most is why are yields rising? rising? Probably the Fed. And then how fast? Stay tuned. As for inflation on the day, we are seeing it influence the results of some companies. PepsiCo at this point down 1.5%. They put up a great quarter relative to demand and volumes and sales, but operating margins 10.9%. One analyst saying that's the lowest in about 20 years on these rising commodity prices. Similar story for Unilever, a very nice quarter there. One analyst, though, saying their margin outlook for the next 2 years, they're saying profitability will be difficult because of rising inflation is ugly. That's their margin picture. On the other hand, take a look at Disney, up 5.9%, a great quarter, beat profits by more than 85%, having everything to do with parks. Subscribers very strong. They're saying that their Disney Plus streaming service is likely to accelerate into the second half of the year, so really going right past Netflix. And then Uber also going very fast, no pun intended, Guy. I know you love cars, of course, but up 4.1%, a great quarter. Their outlook strong. Also, the diversification of delivery, very important there, Guy.
We're going to be talking to Aston Martin a little bit later on. We'll get all of my car enthusiasm out at that point. But Abigail, we need to refocus now on what is happening with the story you've been focusing on, and that is the impact of inflation. The annual inflation rate in the United States hitting a little earlier today as it dropped onto our screen, a 4-decade high, 7.5%. That's the headline number. The latest consumer price index rose last month by significantly more than expected. The question now, what would this mean for the Fed? What does this mean for the Fed? The market is now pricing in a 50-50 on a 50 basis point hike in March. Is that realistic? With us now, former Richmond Fed President Jeff Lacker. He's now an economics professor, of course, at Virginia Commonwealth University's Business School. Jeff Lacker, great to see you on the program to get your insight. We really appreciate it. The market, as I say, 50-50 on 50 for March. Which side of the fence would you fall on?
I think there's a very strong argument for a 50 basis point move at the March meeting. If they move just a quarter of a point, it would beg this question. They're clearly late. They've delayed last year, starting off on the tightening process. They've got a long way to go. That's very clear. It would raise the question of why. And moreover, it would cement this perception of them as somewhat addicted to gradualism. I think gradualism is what bit them last year and is what led to them delaying so long. So, yeah, 50 basis points is a strong argument in my view.
Well, Jeff, I think there's a thought here that the longer it takes to actually hold on to inflation or rein it in, the more hikes are going to be required. How long will it take for the Fed to get a handle on this problem?
It's hard to quantify, but very substantial rate increases are clearly in store. The Fed has to raise interest rates in order to restrain the growth of demand. They have to significantly restrain demand. And if they don't do that, the inflation will continue to roar. That's the mechanics of how things work, of how monetary restraint functions. And so they've got to get ahead of things. So I think they've got to send the signal that substantial rate increases are coming. I think you saw Chairman Powell try to do that at the January press conference, and I think they'll continue to do that.
Do you think the message has not been strong enough? The market seems really comfortable with this idea that inflation comes back down, that we're going to see a peak and then we're going to fall back relatively quickly and get back down to, I don't know, circa 2% in the not too distant future. Are you saying you don't think that's going to happen, given current market pricing? Do you think that we're going to need to see even greater monetary policy tightening to deliver that outcome?
I think financial markets have a history of underestimating the persistence of inflation. We saw that in the last episode of an inflation surge in the late 60s and throughout the 70s when inflation surged. So I discount that. I think what really matters for inflation isn't what financial markets think is going to happen, but more what people on the ground see, what businesses see. Are they able to pass on cost increases? Are they able to pass on higher payroll costs, higher input costs? And if they see demand showing up and their costs are going up, they're going to act and pass that on, whether financial markets expect it or not.
Jeff, I think there's a big fear in the markets right now, and arguably among economists and strategists as well, that somewhere along the line, the Fed is going to make a policy mistake. But let's say, just for to be devil's advocate here, that they get this one right. They're able to successfully kind of pull us out of essentially these emergency measures that the pandemic had brought on. Well, historically, recessions happen every 4 or 5 years. So does this set the precedent for future recessions and how the Fed handles it?
I hope that they learn a lesson from this, that in essence, they made a big mistake last year by essentially learning the wrong lesson from the last expansion. I think they're going to be a little more hesitant to pull out all the guns and blaze away with asset purchases and keeping rates low and tamping down the yield curve. Next time, I think they're going to be a little more cautious about the possibility of a surge in inflation coming out of a dip. If they get away without causing a recession this time, I think they'll be a little chastened.
Jeff, what impact do you think, given the nature of the inflation that we're seeing at the moment, will rate hikes have? And what impact do you think rolling off the balance sheet will have? I'm just wondering what you think about the cause of the inflation we're looking at the moment is, and what the best levers to pull to deal with it are.
I think the balance sheet is just a marginal impact. I think it's more valuable as a symbolic tool for communicating their stance and approach to policy. I'd like to see them set a course for relatively soon and rapidly rolling off the balance sheet, and in particular, rolling off the MBS holdings as rapidly as they can, perhaps even shifting them into treasuries, because there's no godly reason why the housing market needs more stimulus at this point. So I think rate hikes are the main attraction here. And as I said, they act by restraining demand. So they're going to throttle action in the housing market. Sales will decline. You'll see housing construction fall off. And then more broadly, they'll dampen investment spending, perhaps, but dampen consumer spending more broadly. And thought of it that way, you can see why very substantial hikes are going to be needed in order to have a significant bite on demand growth.
So what about, where does the fiscal policy fall into here? Because there are several things that perhaps the Biden administration can do. The Build Back Better plan, perhaps releasing more crude from their SPR reserves. Where does the Biden administration fall into their partnership, essentially, with the Fed?
Hopefully they're cooperating, but I think unless there's a substantial reduction in deficits going forward, a substantial pullback in spending or increase in taxes, the main attraction is going to be the Fed and their interest rate hikes. I think the ball's in the Fed's court. There was a big financial stimulus, a big fiscal stimulus last year. Traditionally, that's meant tighter monetary policy commensurately to offset the potential inflationary effects. The Fed didn't give us that. They got to give it to us this year. I think that's where the action's going to be.
Jeff, do you think the fact that we're now seeing other central banks, and I'm thinking here about the ECB in particular, starting to move on a more hawkish tack, makes the Fed's job a little bit easier? Is there a danger that actually rates are being held too low for too long in the United States as a result of the policy in Europe, the negative depot rate that the ECB has lent on pretty hard? And as that starts to unwind, does that accelerate the move upwards in terms of yields, and therefore allow policy to work a little bit more effectively?
I think the ECB's policy shift in a more hawkish direction will make the Fed's life a little bit more easy. The Fed, nonetheless, though, focuses on domestic monetary conditions, and I think that the domestic inflation picture is what's going to be front and center in their mind. Sure, at the margins, policy works also through sort of a trade mechanism, but a trade channel. But I think, and because of that, I think the ECB and the general tightening of stances around the world are going to help the Fed, ease their concerns about negative effects on the foreign account balance.
Well, Jeff Lacker, former Richmond Fed president and Virginia Commonwealth University School of Business Economics professor, we thank you so much for your time. This is Bloomberg.
We welcome now our Bloomberg television audience and radio listeners from around the world. A fantastic interview in prospect. Aston Martin unveiling its new car that it will take into Formula One's 2022 season. A new era of aerodynamic regulations coming into force. Aston Martin's F1 team owner, Lawrence Stroll, and Bloomberg's Matt Miller, of course Matt Miller's here, are here to talk about that car and where we're going to go from here. Lawrence, great to have you on the program. Thanks for taking the time on such an important day for the company and for the team. Let's just talk about the car first of all. The 2021 season car was held back by regulation. You decided, therefore, that you were going to focus a lot of your attention last year on this car, the 2022 car. What are you expecting from it? How big a step forward is this car versus last year? And what are you expecting it to deliver, therefore, when it comes to track position?
First of all, nice to be here. The 2022 are probably the biggest regulation changes that have ever happened in Formula One as far as chassis rules are concerned. So it's a brand new car for everybody. It goes to a ground effects car, which means the air goes under the car rather than over the car. And, I've said many, many times that this is our second year in a 5-year plan to get to be fighting for world championships. I recognize what it takes, putting the right people, the right tools, the right processes is in place to be fighting for world championships. We're currently under construction, building the greatest new state-of-the-art Formula One campus. Last one was built 19 years ago. It'll be, as I say, the latest, greatest. So getting that part of the tools, we've been hiring, like any other business, maybe Formula One even a little more so. It's all about having the best people. We've hired about 300 people in the last 2 years. So all this is on our journey to be fighting for world championships. As I've pointed out many times, this is year 2 of a 5-year plan.
Yeah, and your son, Lance, is piloting one of the cars alongside Sebastian Vettel. Vettel actually podiumed in the last season. Do you expect to be getting a first-place finish? Will you win a Grand Prix in 2022? And also, how do those two get along? Do they work well together?
They work extremely well together. There's a significant difference in age. Lance is just in his early 20s. Seb's in his mid-40s. So Seb has a lot of experience. Lance, even in his early 20s, did his 100th Grand Prix last year in Abu Dhabi. So he's now getting the time he needs as well as his exceptional speed. But they do work well together. They're great teammates. As far as finishes go, listen, as I say, for us, it's early days. It's our second year of what I told you is a 5-year journey. So, listen, it's all new set of rules. We don't know where it'll all play out, but we'll find out very shortly in 6 weeks at the first race in Bahrain.
Can I ask you if you think the new rules are going to make it more exciting as well? Because, when I first started watching Formula One, there were 12-cylinder, 10-cylinder engines that boomed. You could feel it in your chest. It was exciting, and that's really what drew people to the sport more than the kind of drama of the interpersonal relationships. As we get closer to Formula E, I don't know what's going to bring in the fans. Are they going to at least be passing each other?
They will. I mean, let's be clear. Formula One as a sport has never been greater. Just at the last race in Abu Dhabi, we had 180 million viewers. It was the largest viewing audience of any sporting event in the world in 2021. So Formula One itself has never been in a greater place.
Lawrence, Formula One as a sport, can we just talk about that for a moment? You talk about Abu Dhabi. Michael Massey's decision at the end of that race, for many people, turned Formula One from a sport into entertainment. What do you think about that?
Just to finish answering the first question, I do agree with you that V12s and V10s and those visceral Formula One cars had a very, very special appeal. Clearly, as automotive manufacturers, there is an electrification component to our future. So I do believe that the hybrid system that we currently have, which a great combustion engine and electrification, it's clearly, and I agree, not quite exciting as a V12 or a V10, But understanding where the world is going, probably the right thing to do. As far as Michael Massey is concerned, I'd rather not comment. He's a person who I believe tried his best. I don't believe there was anything more to it than a decision. Whether the decision was right, whether the decision was wrong, I don't believe a decision was made to cause more drama in the sport.
Lawrence, can we pivot to the really fun stuff, which of course is your bond issue? You canceled it for the F1 factory. I'm curious how you plan to fund the development of that factory and the wind tunnel.
I think Formula One racing is a lot more exciting than the bond issue, by the way. But on the note of the bond issue, I had a much better alternative. We did a financing arrangement with Canyon, who financed the whole project instead of what was originally going to be only one part of the factory. We have 3 buildings that form the campus. Canyon and I have a long-standing relationship, and they stepped in and chose to finance the whole thing.
I want to ask about the DBX. I absolutely love the truck. I'm not like a Gen Z jalopnik hater. But I wonder when it's going to get, or if you can give it, a really strong hybrid drivetrain. I know right now you've got the 707 out, which has immense power. But would it benefit from a battery in addition?
What we do is we listen to the customers. When we very successfully launched our original DBX only 14 months ago, and in our first full year of production in 2021, we took 20% of the luxury automotive segment. That's an incredible feat in one's first year in business. We also, in listening to the customer, our customers said, listen, we love the vehicle. We think it's the best looking SUV, certainly the best driving SUV, drives like an Aston Martin sports car, much better in comparison to others. However, we would like a little more power, or even a lot more power, more performance, which is what we know how to do. So we came out with the most powerful and most performing, not only horsepower, but the most performing new suspension, new gearbox, new underpinnings, the most high-performance SUV in the sector. It'll outperform anything else, including sports cars, even though it's an SUV. So we listen to our customers. Our customers telling us first, we want more performance. What the customer is saying at the moment is a distant second, but we are doing regardless. In the next 18 months, we will have a fully hybridized DBX SUV that will have significant, if not greater performance to our 707 with a hybrid electric system. By the way, not only the DBX, if I could just go a step further, we will have all our cars. So we've already introduced 3 mid-engine cars that are electrified. Our famous Valkyrie, the Valhalla we introduced in June at Goodwood and again in Pebble Beach, and our straight 6 DBX, which we sell in China. So we already have 3 electrified vehicles we sell at the moment. We will also be bringing hybridization to our front engine program as well as our DBX in the next 18 to 24 months.
Lawrence, I've got 30 seconds left. You were 7th last year in the constructors. What are you aiming for this year? Better than 7th. On that note, we will leave it. Great looking car.
As I said, it's a journey.
It's a journey, a 5-year journey, as you say. Aston Martin F1 team owner Lawrence Stroll, thank you very much indeed, sir. And of course, our thanks as well to Matt Miller. We're going to talk more about the markets. We'll get back to the CPI number in just a moment. Coming up on the European close, Bilal Hafeez. I understand he's just entered the building, so he'll be up here very, very shortly to talk to us about his reaction to the F1 story. No, the CPI number story. Bilal Hafeez coming up, Macro Hive founder and CEO. This is Bloomberg.